Hello, everyone. Welcome to the Nasdaq Dorsey Wright podcast for the week ending on March 7th. I'm Ian Saunders and joined across the table by Chuck Fuller. Chuck, good to be back here with you.
Yeah, good to be here.
It's good to have you on. We figured once things get hairy, we like to pull in the big guns, right? and have people. And it's also this podcast is going to be coming out on March 7th, Employee Appreciation Day. So that's
Do you appreciate me?
do you appreciate me? I think that's a better question. And so yeah, not appreciating this market movement though.
Yeah.
There's a lot of stuff going on over the past few days that, like I said, I want to bring the big guns, kind of get your perspective on what's going on. For those who might not be familiar with Chuck, I mean, we have you on. I was looking back about once a quarter,
Yeah, sounds about right.
typically.
Yeah.
I think you were back on to the end of December. Things looked a little bit different then than they do now.
Yeah.
But you've worn a lot of hats here at Dorsey Wright. You have done some coding stuff on the website, kind of built up a lot of the platform there. And now you're portfolio manager, kind of take a look at a lot of the quantitative testing and strategy building.
Right.
There, right. And keep up with a lot of the indicators and stuff that we're looking at too. So we'll dive into a lot of that. I know we could keep running down your bio, play the guitar, what other instruments do you play, right?
Drums.
What instruments do you not play?
Right,
might be the better
that's
question.
The better question, right.
So yeah, man of many talents, and so we'll hopefully get some good insights here, I'm sure, for the users today. For markets, we've seen just a little bit of a drop over the past couple weeks.
Yeah, I mean it's it's been maybe 5 to 6%, at least on the S&P, so
Right.
a little bit more on the NDX and some different things like that.
Yeah.
But I think the bigger takeaway is that this happens a lot, right? This isn't something that's necessarily a worst case scenario, right? You get at least on the S&P you get roughly 3 of these a year. Now, of course, we don't know that this is the end of it.
Okay.
Right.
Yeah.
It could get worse.
Could get worse for sure.
And there's some things to suggest that maybe that's a little bit more likely that, I think we're going to talk about it here in a little while.
Right.
But what it's done so far isn't anything to get.
And so do you think, so 3 a year, I was looking at some data earlier in the week for the Nasdaq 100, which doubles that. I mean, it's usually almost 6 a year.
Right.
But I noticed that a lot of that, the averages and the means are oftentimes different because a lot for 5% pullback stats, we track those typically as you go 5% down and 5% up. That's an instance, right? In a bear market environment, you get a lot of those in a short amount of time.
Sure. Right.
And so 3 a year is typically not what's actually felt. Right? It's what it works out to be from an average perspective.
Yep.
But the averages still matter. We see it really hit an average like consistently over time, but it's helpful for perspective, right?
Right. But like for instance, last year, by all accounts, great year. It happened a couple times.
Yeah.
Right. 2023, same type of thing, happened a couple times there too. So, just the fact that we've gone down 5% isn't anything to write home about.
And in some people would probably appreciate it. Like it's
right,
because it never feels good to buy at all-time highs.
Exactly. Even though that's actually a bad strategy.
Right. We won't get into that.
We won't get into that. But yeah, it gives you an opportunity to invest in things that are cheaper, than they otherwise were. So that's everybody, even if it isn't a great strategy from a longer term perspective, it's still people enjoy it, right?
Right.
It makes it feel better, to jump in at those points.
So I mean, I guess it never feels good to buy at highs. It never feels good to buy. I don't know. Right now, when it's a lot.
Let's be honest, it never feels good to buy, right? Because you're always going to second guess.
Because you're giving your money away.
Yeah,
you're hoping it comes back.
Exactly.
Right. Hoping it comes back a little bit higher, right?
Yep.
Trusting that it will come back a little bit higher. And so when we're looking at movement, we like you said, we're down a little over 5% at the time of this recording Thursday midday-ish.
Yep.
A lot can change over the next day before this podcast comes out, but down around a little over 5% is for the S&P. We're near that 10 number for the Nasdaq 100, which ultimately, I mean, is not that infrequent. I mean, 10% corrections for a very
it's got 1/5 of the stocks, right? So it's and they're all
a lot more mostly,
very tech related, very consumer cyclical, that kind of thing. So
and a lot of the big names that are up at the top of that Nasdaq 100 have been among the highest flyers over the past couple of years, and also been among the biggest losers recently.
Yeah.
I mean, I think it was interesting. You saw some names that have been coming in or high flyers in the Nasdaq 100 recently. Your Palantirs, your AppLovin, NVIDIA, obviously formerly biggest stock.
Right.
they've been hit pretty hard over the past couple of days.
Yeah.
And a lot of people look toward that as like a momentum blow up.
Yeah, it's kind of like seen as a bellwether
Right.
of what's to come. But I would argue that, especially with the type of market that we've had the last couple of years, I mean, if you think about it, we've mostly been up. Pullbacks have been pretty minimal. That's a great kind of market for momentum because you don't get a lot of these leadership changes where the trends stay intact. And so, those momentum names tend to stay intact. And so what ends up happening is a lot of times you end up with higher beta names that come in because those are the ones that tend to outperform in those kind of environments.
Right.
And so, yeah, it's not too surprising that, if it, when momentum kind of, falls out of bed a little bit, that it takes it on the chin a little bit more after having a couple of years like that.
So does something like that break a model? Does it like break the strategy? Like,
No. I mean, you got to figure like, using, some data from like Ken French, that stuff goes back to 1927, right? Like this high momentum strategy has definitely seen things like this before, right? And it still works over time.
Yeah.
It's just that it's not the type of thing where it's going to work every single period like you want it to.
Right.
That's what we want it to happen. Every single month, every single quarter, I want it to work.
Yeah.
And that's just not it's not going to happen.
It's not the case.
Not the case.
Or else we wouldn't be here. We'd be on a beach, not recording the podcast.
Right. And everybody,
maybe recording the podcast.
Everybody would be because everybody would notice it. And they'd all try to do it. Of course, then it wouldn't work for others.
Exactly.
Right?
Exactly. So, that makes sense. And John talks about it some too. I'd like that he has a slide I've seen on just a few of his presentations, start by pulling the weeds, right? And so a lot of times within these environments, I mean, it's going to happen. And then same thing with the value stock can blow up too.
Oh,
right?
Absolutely.
Sometimes more so. Won't get into that argument. But it's not about having the stocks in your portfolio. It's not removing them when they go down.
Yeah, exactly.
Having a process in place to do that.
Gotcha.
Which momentum at the end of the day, that's all it is.
And yeah, it's just a process, right? So yeah, if you're not getting rid of those stocks that are breaking down, more than the market or whatever, then that's the problem, is not following the process. And too often that's what we see happen.
Yeah.
Because you second guess it, right? And that's, again, I think I bring this up maybe every podcast or at least every webinar that I do. It's any factor that works. It's gonna only work because it requires you to do things that you don't want to do. Right. Otherwise, everybody would do it. And so, yeah, the momentum's certainly like that, and values like that too, right? You can't just keep holding on to a stock because eventually it gets too expensive. Right?
Sometimes it goes to zero.
Right. Sometimes, Sometimes you're catching the falling knife.
Yeah.
Right. So yeah, in other words, investing's never going to get easier. Right. It may just get harder.
Right. Probably. Yeah. And catching a falling knife brings up a good point, because I think a lot of people, I mean, you've seen the video a lot over the past couple of years. I don't have the exact number in my head, but it was down a lot in 2022, and it's rallied significantly. It wasn't even in the top 10, I think, from a market cap perspective at that time, and it was the biggest stock in the world, right? Waiting for a time to get in, and now it's moving lower. Yeah, but that might not mean it's the best stock to buy right now. Right. I think it's another helpful thing, at least when we're looking at things from a relative strength perspective. I mean, we've seen NVIDIA's had a big drop in the past couple of weeks, but it's been declining and really showing a wide but consolidating range since June of last year.
Yeah, it's kind of what we've seen from semis, period. Yeah, they haven't been great, which kind of flies in the face because I feel like the narrative's still there, the whole AI thing and all that kind of thing.
Is it? I haven't heard about that in the past week.
Well, yeah, maybe not the last week, but at least over the last few months, right? The narrative's still there. But people are wondering, has there been too much investment in these areas? Is it really sustainable to keep, putting hundreds of billions into these things every year? I think they're good questions. And really what I think what needs to happen is we need to start seeing some real world AI proof, right? Not just like right now, it's kind of been somewhat parlor tricks, like, oh, look what ChatGPT just did for me, right? That's kind of interesting. And we've seen I've personally seen some productivity improvements from it. Totally. But I think we're at the point where we need to see it in companies' bottom line.
Yeah, and some of the stuff, I mean, I think there's a lot of thoughts, especially with something like AI, that comes up when when it launches, right? You can think, oh, you can project out what it's going to
Sure.
do to the workforce or whatever. And it's in a similar vein when the whole DeepSeek deal happened. What in January? January, yeah, right toward the end of January. A lot of thoughts were happening like, oh, companies they're not going to need to invest anymore.
Right.
And then that news cycle was quickly followed by a lot of earnings announcements from some of the major tech corporations, which all obviously announced that they were continuing to fund the investment. But I think the assumption in both instances is like the mind immediately goes to what the end state is, but it probably takes a lot longer to get to that end state than what's actually going to happen. It seems a little unrealistic for the DeepSeek thing to happen, and then a week later, Microsoft changes its earnings report because of that. Right?
Yeah.
Like they already had that stuff planned out, and it's not going to change the report.
Yeah.
Whereas a lot of time the zeitgeist would be like, oh, Microsoft said they're still investing. We're all good.
Right.
Maybe in 6 months, that's not the case.
Yeah, if you work for a big company, you know that any kind of CapEx projects take a long time to get approved, or even to dream up, and then to get approved, and then to actually do the work to spend the money. Yeah, it's a long-term process. That it's like moving a aircraft carrier. It's not like it's not like oh, I just
hopefully don't get stuck in the canal.
Yeah, right. So yeah, and the DeepSeek stuff is interesting.
Yeah.
Because obviously it brings up the point, well, do they need a lot less computer power to be able to train these things and that kind of thing? But I think on the other hand, it's the type of thing where they can also now use the same amount of computer power to make something even better. Yeah. And I think that's what a lot of these guys are looking at.
Point.
It basically just it's a way to make it 20 times more efficient than it otherwise was, but we can still buy the same number of GPUs, right, and just make a 20 times better model like that,
right?
In theory, as long as everything scales the way it has been,
right?
But it's tricky, and I think that's I think that's why you kind of saw that news. It was like a big thing. Yeah, it was a big thing all of a sudden, and then kind of rotated because people kind of realized that, oh yeah, this is just going to get to this end state even faster.
Right. That just speeds it up.
Yeah.
And so, I mean, one thing that hasn't been sped up though is we've seen a lot of movement over the past couple of weeks, but we haven't seen much change from like a sector rotation perspective, at least at the top end of the sector rankings. I was looking at the rankings, like financials. I actually didn't look at yesterday's movement, but they had still up until yesterday actually gained a few buy signals throughout the course of the past few days since the end of February. Same thing for communication services in a second. Tech has lost some steam, fallen from a signal count, but it still sits in third. I mean, we saw semiconductors fall out of favor last year.
Right. So
that kind of our relative strength movement already kind of happened in a lot of our systems. Technology is still kind of hanging in there in the top three, but you were talking about some other areas that shown some surprising improvement, maybe from the bottom end.
Yeah, I mean, we've seen utilities is up in the top 5 now. That's first time since 2022, which sounds a little ominous.
It does. Yeah. But it's not the same utility sector as it was then.
Right. Yeah, it's a different kind of thing.
Market's always different, but
yeah, of course, I don't know that we've ever seen utilities, be a kind of a bellwether of growth.
Some of those utility stocks looked like Nvidia. Like, I mean, it was
right. It almost takes utilities back to the 20s when they were like the tech of their day. Right?
Yeah.
But so I don't know that you can read too much of a bearish slant into that, given what's been going on the last year. But still, it's kind of noteworthy, because it's been since the last bear market that happened. We're starting to see some things move up off the bottom. Real estate, I think, is kind of a big one. They were plumbing the depths there for a while. And now they've kind of moved back up. And they're actually if you look at it from an asset class perspective, they're the second best performing asset
real
class,
estate is
this year. Followed with international up at number 1, which nobody would expect, right? If you weren't looking at the numbers.
Well, and if you were coming in, I think until last year, even those that do look at numbers, and you think, okay, tariffs, conversation around tariffs,
it was terrible.
Even if they don't come in, it's not going to be good for international equities. If they do come in, it's going to be worse. Kind of not been the case.
Yeah, it is. It has not been the case at all. And then part of that is the falling dollar, right? That helps them. I think dollar's down roughly 5% from the peak. and that's been a pretty swift move, right?
Mhm.
And so that certainly helps them. Two, I mean, there's just been a lot of talk about, these European economies starting to invest more in themselves, whether it's from a defense
Yep.
standpoint,
Yep.
or whatnot.
Which is going to increase GDP.
Yeah,
And
that's gonna, right, that's gonna, help, a lot of those private companies, do better than what they have been. And I think there's a lot of hope that maybe this is a way to kind of kickstart them out of the doldrums that
Yeah.
they've been in. Of course, we've seen this happen before, right? I feel like international has always been just around the corner
Just a couple years ago.
yeah, I mean,
2023.
yeah, I mean, I feel like since 2008, it's been like that, right? There's always been, it's doing well, and then it finds a way to fall apart.
Well, you look at that graph of like trailing 5-year performance of like the excess return of the S&P against ACWX or whatever it is, domestic against international equities, and it's cyclical. Like it goes up and down over time, and it's just
It's been a long
US
cycle.
for a while.
Yeah, it's been
right.
a long
The assumption would be at some point it's going to swing back down.
You would think so. I mean, when we're in this kind of mode where, you look at the PE ratios of the stocks in the international space versus the US space. I mean, it's a pretty strong difference.
Right.
The PE ratios for international stocks are very low compared to US. So, but it still requires that catalyst, right? Somebody's got to come in and start buying them to start moving it up. And maybe that's what this is.
Maybe.
But again, we've seen other years where this, it's happened and it kind of falls apart. So
Yeah.
I don't know at what point. I mean, I guess, if we saw international, hit number one in Dolly,
which is not been the case.
I can't remember.
We haven't.
When was the last time we saw that?
2023.
Was that in 2023?
Yeah, we were for about a 6-month stretch in 2023.
Right.
It popped up into the top with some weakness that we saw in the US dollar, but then we started to see a little bit that consistently trending US dollar decided to not consistently trend for a couple of years there.
Right.
Which still the trend changes still worked out. It just wasn't as beneficial or long lasting as it had been for the prior 10 years.
Right.
But yeah, international equities has ticked up. So yesterday it ticked up 4 buy signals in Dolly.
Yeah.
Commodities dropped 5. So you're seeing that. I mean, international equity still third, commodities in second.
Yeah, and really though, what's interesting there too is like what's going on kind of underneath the surface. I mean, I think Europe is up like 15%.
Yeah.
That's, I mean, we're only 2 months into, or a little over 2 months into the year. I mean, that's a extremely strong return,
especially for Europe. That's a strong return for anyone.
Right. Yeah. Like when's the last time Europe was up 15%
for a country like Turkey or China? I mean, that's like that. Okay, we've seen that.
Right.
Europe.
But not for the region as a whole.
Right.
So it's interesting. I mean, really, I'm looking at the regions right now of the world. I mean, the US is at the bottom. Every single region is outperforming the US and by a decent amount. I mean, even Asia, which is maybe getting the headlines right now, is up 5% for the year with the market down.
And China's had a good past couple of weeks.
It has
because of their, 5% GDP announcement that they're targeting.
Right.
I mean, that's
so, I mean, it's always something to keep an eye on because it's like you said, at some point it's going to turn around.
Right.
And I don't know. Do I hope that now's the time? I don't know if I hope it or not. I'm still mostly invested in the US. So.
Right. And because the indicators are telling you to do so, right? And then if they change, then maybe we'll change from there.
Yeah.
But one of the indicators on the US side, I mean, when looking at some of the difference, we have a variety of different indicators.
Mm-hmm.
You've honed in on a few, and I think the last time we had you on the podcast in December, you're talking about this interesting phenomena with a divergent potential in the market,
yeah. So,
which has since triggered, right?
Yeah, it did trigger. And for people who aren't familiar with what it is, but basic idea is that, sometimes you get into these market modes where, the indexes are doing good, right? They're up near highs, but the average stock isn't, right? And so like, for instance, right now, I mean, the market's, 5 to 6% off the high, but the average stock in the S&P is about 17.5%.
Wow.
Right. It's probably even a little bit more after today, right?
What are you looking at that? Like not RSP?
Oh yeah, I'm talking about looking at every single stock in the S&P, comparing it to its 52-week high.
Okay.
Where is it at?
Okay.
And so they're down about 17.5%. Actually just ran the numbers on Index too. It's a similar type of thing where the average is down about 20%.
Okay.
Off their high. And so there's a fair amount of damage that's being done under the surface that's, larger than what you would think if you're just looking at the indexes.
Right.
And so, when you see this kind of thing happen, it opens a window. I like to say it opens a window for larger drops in the market as a whole. Because you think about it, somehow that kind of divergence has to get healed in some way, right?
Right.
And it's either that the average stock all of a sudden, starts to do well and kind of comes back up in performance, and gets closer to the market. But more often than not, I feel like it works the other way.
Right.
That the market falls apart to kind of come down where the average stock is.
And so if you think about like with your soldiers on the battlefield, soldiers
Right.
lead the battlefield, lead the generals out there is kind of
Yeah.
that divergent state.
That's
Either
exactly.
the soldiers come back in with force or the generals turn around and run too.
Yeah, exactly. Right. And more often than not, it tends to be that the generals run.
Yeah.
Especially, I mean, it seems like it's, we're probably, I don't know, a couple months into this thing now.
Because it triggered at the end of December.
Yeah, it was like the very beginning of January. I have to
Right.
look. It was something like that.
Yeah.
What I'll look at for that. But we're a couple months into it, and the market, it came back to a certain degree, right? Like we popped up there for a bit, but we didn't really, we didn't see the average stock really start.
Markets at new highs. I mean,
Yeah, market was at new highs,
Yeah,
right? The average stock definitely was not.
Yeah.
And so, really you want to see that average stock start to do well and get that kind of broad participation
Right.
coming back in. Or just again, it kind of leaves the door open for, and I'm not saying like going into a bear market, but it just, you figure like an average bull market correction, roughly 10%.
Yeah.
But occasionally we get these 15 to 20%ers.
Yeah.
Right. They tend to be preceded by this kind of thing.
Got it. Got it.
And so, they just gotta kind of keep an eye out for something like that. It's one of those things that you don't want to have to go through, but the way I also like to look at it is, the market tends to be like very asymmetric, right? In other words, you get a lot more up years than down years. Right? I'm 44, and I think there's been 8 or 9 down years the entire time I've been alive, right? So it's kind of shows you how skewed it is to the upside. The way I like to think about it is when you're in a divergence, it's almost like the skew goes away. Now you got an equal opportunity to either go up or go down.
Yeah.
And those windows don't stay open for a long time.
Right.
But I'd say that we're in one right now, but it's no guarantee, right? The average stock could start doing well, today or tomorrow, or whatever. And we get back to new highs and everything's good. And, that happens sometimes.
Yeah. So what kind of indicators are you looking at to track that?
Yeah. I mean, looking at things like
in terms of what would take us out of it.
Oh yeah. I mean, so yeah, looking at some of these, let's say some of the short-term indicators that we're used to looking at, things like the high-low, or looking at the TW on the S&P
10-week, and for the like TWSPX, the essentially what percentage of stocks are trading above their 10-week or 50-day moving average.
Yeah, exactly.
Which is right now 42%.
Yeah.
I would have assumed it was lower.
Right. Yeah. So that's been one thing. We've pulled back, and I would have expected it to pull back a little bit more, but I think there has been some rotation going on underneath the surface. Tech and consumer cyclicals kind of falling apart here. Some other sectors have been doing pretty well. You got healthcare that's up 9% for the year. And really 9 out of the 11 sectors are beating the S&P right now.
It's very different from the prior couple of years.
Yeah,
I mean, in 2023 and 2024, there's like 2 sectors beat the market, which is not good.
Yeah, exactly.
For the market.
Yeah. This kind of, so it's been able to kind of hold up, right now. But to me, like seeing those things, really get back to the other side of the field, like not just like, oh, they're at 40, they're at 50. Now we need to see them 70, ideally 80 plus.
80. And 80 would take us, if we get TW back to 80, that
would say, okay, yeah, this divergence is done. That takes a broad push to do.
Right.
A lot, 80+% of stocks have got to be moving in the same direction.
That's a breadth thrust.
Maybe not. I might not go that far.
Okay.
But it's enough to, usually like people say like 90+.
Yeah, okay.
It's a breadth thrust. But yeah, it's still like very, very good.
Okay.
From a breadth perspective. And So yeah, that's what I would say. And sometimes that can take a long time, like longer than what you'd like to see that come
Like
back.
how long are we talking?
I mean, I'm trying to think of like recent history. Where the market
Few months, few
didn't kind of fall
years.
apart because
Like,
really the last time this happened was the end of 21.
right.
And there kind of it fell apart.
Fell apart.
You had a bear market. 2018 might be the previous time.
Okay.
And there you figure the market fell apart towards the end of the year. It's kind of like the October time frame.
I remember that December
What
24th very well.
but I think the divergence kind of happened earlier in the year around
Got it.
Armageddon, if you remember that.
Yep. On
That
February.
was February. Yeah. So
Yeah.
that's like a 8-month period of it's just kind of the door's open, but you don't know when it's
Got it.
when it's gonna happen.
And we've been like 2 months.
Yeah, you just kind of got to be vigilant.
Yeah.
And again, we're a couple months in right now. Who knows? Could be another 6 months, or it could happen tomorrow. Or the average stock starts to do really well. It's not even an issue. That happens.
An interesting deal. So when we're looking at other stuff, and I know there's one other deal I wanted to hit on with back in that period, let's say your 2018 or even your 2021, you didn't see that many people that were super bearish.
Right. Yeah.
You do now.
Yeah. It's
right?
It's a different kind of environment now. I mean, looking at things like consumer confidence, the very low. And I think probably the point you're trying to bring up is the AAII survey, right? So
we were talking about that just before hopping. Those numbers just came out. Yeah.
So the AAII survey, if you're not familiar with it, it's a survey of retail investors, right? And basically asks them every week, what percentage, or are you bearish, are you bullish, or are you neutral, right? And then they take the percentage of the respondents. And so just last week we were looking at it, we're kind of floored because the percentage of bears jumped up to 60%, which is extremely high.
Which we hit in 2022.
We did, but we hit
rightfully so.
but we hit around the bottom in 2022
in September,
right? Not like 5% away from the peak,
right?
That's the weird thing. And so, and typically, you typically see this kind of up in the nosebleeds around the bottom. I mean, I think before 2022, you had to go back to like March of 2009.
I was going to say, I'm going back now. Yeah, March of 2009.
It was like March of 2009.
Hit 70.
Hit 70, right. So, and just looking back, it tends to be very correlated to bottoms. That might be the case here, but usually it's after you've gotten killed in the market.
And it hit 60, but prior to that, it hit at 60 in October of 2008.
Yeah.
I mean, it's slightly different environment then.
Yeah, now that was actually a short-term bottom.
Right.
At least now the world
that was right after Lehman.
Yeah, market's going crazy there. So that's kind of a different type of environment.
5% away.
We're not 5% away. Yeah, it's a much different market environment. So I'm not sure I've seen a time.
So what do you think it means moving forward? I mean,
hopefully we're at a short-term bottom and about to.
I mean, just looking at the numbers for what they are, that's typically what it means.
That's what you would think.
It's a contrarian indicator. When this goes up, markets are typically when this goes higher, markets are going higher shortly thereafter.
I have a pet theory about what could be going on.
Okay.
A lot of times you'll see different things about, what people of different political stripes are thinking about the economy. And obviously we know like the world is very polarized from that standpoint these days. And I think that the last I saw that was that Democrats with Trump coming in were extremely bearish on the economy. And so it kind of stands to reason that, especially with stocks pulling back a little bit, maybe the average Democrat is the one kind of pushing that up.
Who's more likely to respond to a survey? Someone who's super happy or someone who's super bearish?
There's that too, right? Of course, they're asking people every week. You're always going to get some of that.
I've also seen some interesting stuff, and I don't know if they're like, I don't have any word to but that the number of respondents for some of these surveys has reduced over the past few years.
I've not seen that.
Looking at less people. I don't know if that is.
And maybe that could be a part of it too. Who knows? But it's interesting. It's I don't totally know what to make of it. Again, hopefully it's we're at a short-term bottom and it's nothing to really worry about. But with all these other things kind of going on, like we talked about with the divergence, it does make you wonder. You know, and again, even with that, it could be the type of thing where we do get a short-term reprieve, and then, but maybe it's not enough to really, you know, get the average stock really going, and we're just kicking the can out further.
Yeah, and at the end of the day, yeah. I mean, if at the end of the day, that if we get like a downward move like we have been, a little bit of a reprieve, what's that going to do to relative strength charts? It's going to cause a column change, which then all of a sudden, when we if we do ultimately get a bigger move down, the signals will happen quicker.
Yeah, they'll happen quicker.
Right.
That'll be good for,
Yeah.
you know, allowing us to rotate out,
Right.
And that type of thing. And so, yeah, it really, and that's what the relative strength has the hardest time dealing with very kind of short-term
Sharp
moves in the opposite direction of what it thinks is going to happen. So,
AKA COVID.
yeah, COVID's the obvious,
Yeah.
you know, any kind of crash type market, is the worst for it. But these types of markets that just kind of, if it were to just kind of grind its way down, those are actually really good. I mean, if you go back to, I always think of like the tech crash, 2000, 2002, it just, you know, yeah, that was 50+%, at least on the S&P.
From top to bottom.
From top to bottom, but it took, you know, 3 years to play out, right? And there was all kinds of things going on under the surface. You could buy financials, utilities, all these, lots of sector rotation that
not everything was down 50%.
Exactly, right. It made momentum work pretty well. But yeah, again, these COVID type situations, you know, anything that's sharp and quick, which to be honest, most things happened since I'd say 2008.
Yeah.
Even though they haven't been like, you know, as big in magnitude as 2008.
Yeah.
Like I just think about, you know, 2011, you know, okay, flash crash in 2010, 2011 was the, you know, the whole government, you know, shutdown type of thing.
Yep.
And that was like a month, you know, we're down 20%. 2015, 2016, a little bit like that. 18 was certainly like that. I mean, 20, yeah, I mean, it's just in the COVID, almost every single thing like that. Even 22, there was a bear market, but it was a bear market that was over pretty quick.
Yeah.
You know what I
bear
mean?
market in the recession. I mean,
Yeah. It was over fairly quick for a bear market. So yeah, you kind of forget that, you know, in a more traditional bear market that takes a little bit longer to unfold, you do tend to get a lot of sector rotation.
Or even if it's not a bear market, if it's just a sideways market.
Yeah,
I mean,
right.
that is also can be pretty conducive for trend following strategies, because if the market's moving sideways, some stuff's going to do well, and some stuff's not going to do well. And you follow a strategy that can take advantage of those stuff doing well.
Yeah,
it's the whole point of momentum, right?
Right.
I mean,
exactly.
Yeah.
Yep.
So there's some light at the end of the tunnel for some areas.
Yeah, absolutely. Yeah. I think that you know, we'll just have to see how it plays out, but I do think that, you know, there's nothing to worry about right at this moment.
Cool. And so final, what's your S&P price target for the end of the year? No, we won't dive into that. But no, is there anything else, other parting shots, other things?
No, I think we're good. Yeah.
Cool. Well, Chuck, thanks for popping back on again with us here. I kind of forgot we're recording for a minute there. But at some point we do got to wrap this up. So thanks everyone for tuning in and listening this week. We'll be back to touch base on any other action next week.